step-by-step guide. If you're in the UK, you've probably heard that India is one of the fastest growing economies in the world. But here's the problem. Most UK investors don't actually know how to access it. And in some cases, they're trying to invest in India the wrong way. In this video, I'll show you the simplest way UK investors can get exposure to Indian stocks, step by step. Now, the short answer is yes, you can invest in India from the UK, but usually not in the way most people expect. You typically can't just open your regular UK investing app and directly buy shares listed on the Indian Stock Exchange like you would with US stocks. India has restrictions around direct foreign retail access, which makes things slightly different. But that doesn't mean you can't get exposure. There are three main ways UK investors can invest in India, and one of them is far simpler than most people realize. The first option is Indian-focused exchange-traded funds listed in the UK or Europe. This is the easiest and most common route. Instead of buying individual Indian companies, you buy a fund that holds dozens or even hundreds of Indian stocks in one investment. That gives you instant diversification and reduces the risk compared to choosing one company on its own. Many UK platforms offer India-focused funds that track major Indian market indices like the Nifty 50 or broader Indian benchmarks. You're not buying directly on the Indian exchange. You're buying a fund listed in London or Europe that gives you exposure. For most beginners, this is the cleanest solution. The second option is Indian investment trusts listed on the London Stock Exchange. These are UK-listed companies that invest primarily in Indian businesses. You buy them just like a normal UK share. Some of these trusts have professional fund managers actively selecting Indian companies. This can provide slightly different exposure compared to index funds. In some cases, there is higher potential upside, but also higher volatility. The third option is using an international brokerage account that offers access to overseas markets. Some global brokers allow direct access to Indian exchanges, but this is more complex, often requires additional paperwork, and may involve higher fees and currency conversion costs. So for most UK investors, funds and UK-listed trusts are the practical routes. Now let's talk about why India attracts so much attention. India has one of the youngest populations among major economies. It has a growing middle class, expanding technology sector, rising consumer demand, and increasing global investment interest. But growth potential does not mean guaranteed returns. Indian markets can be volatile. Currency movements between the pound and the Indian rupee can affect your returns. And emerging markets often move more sharply during periods of global uncertainty. So if you're considering investing in India, it usually works best as part of a diversified portfolio rather than your entire strategy. For example, instead of putting £5,000 entirely into India, some investors allocate a smaller percentage alongside UK, US, and global funds. That way you benefit from long-term growth potential without overexposing yourself to one country. Before investing, always check what index the fund tracks, the ongoing charge figure, how it fits into your existing portfolio, and whether you're investing through a tax-efficient account like a stocks and shares ISA. So can UK investors buy Indian stocks? Yes. But for most people, the smarter route is not picking individual companies. It's using simple, accessible funds that give you broad exposure in one move. If you found this helpful and you want clear explanations on how UK investors can access global markets, consider subscribing. I post new videos every week.